$84. That is where silver is trading this morning, March 5th, 2026. And here is the number that Bank of America just put on the table, $309 per ounce. Not a Reddit prediction, not a YouTube channel's price target. Bank of America, one of the largest financial institutions on the planet. Their head of metals research, Michael Whitmer, just issued what analysts are calling one of the most extraordinary precious metals forecasts in Wall Street history, a range of $135 to $309 per ounce before the end of this year. I am not going to tell you $309 silver is guaranteed. I am not going to tell you it happens next week. What I am going to do is walk you through exactly how Bank of America got to that number, exactly what the math behind both targets looks like, and exactly what has to happen in the real world for each scenario to play out. Because here's the thing. When a major Wall Street bank puts $309 on paper, your job is not to dismiss it, and your job is not to blindly believe it. Your job is to understand the mechanics behind it, because those mechanics are sitting in the data right now. And most people are not looking at them. Let's build it from the ground up. Every number I give you today is public and verifiable. Links to all data sources are in the description. Section 1. Who Michael Whitmer is and why this forecast is different. Before we get into the numbers, let me be precise about where this forecast comes from and why it carries weight that most silver price predictions do not. Michael Whitmer is the head of metals research at Bank of America, not a junior analyst, not a newsletter writer, the head of metals research at a bank with over $3 trillion in assets under management. When Widmer publishes a metals forecast, institutional investors read it, sovereign wealth funds read it, central bank treasury desks read it. This is not fringe commentary. This is Wall Street's own language being used to describe a silver market that is structurally broken. And here is what makes this forecast unusual. Widmer did not issue a single price target. He issued a range, $135 on the low end, $309 on the high end. That gap is not an accident. That gap is intentional. And understanding why that gap exists tells you everything about what this silver market is actually facing right now. Section 2. The ratio math. How Bank of America gets from 84s to 309s. The entire forecast hinges on one number, the gold to silver ratio. Right now, the gold to silver ratio sits at approximately 59 to 1. That means it takes 59 ounces of silver to buy 1 ounce of gold. With gold currently trading near $5,000 per ounce, that ratio puts silver at roughly $84 to $85. Now here is where Widmer's math begins. Historically, the gold to silver ratio does not stay at 59 to 1 forever. It compresses. It has compressed before, dramatically. And when it does, silver moves faster and further than gold. Target 1, the $135 scenario. Widmer applies the 2011 ratio low of 32 to 1. The last time silver had a major bull market peak, the ratio compressed to 32 ounces of silver per ounce of gold. Apply that 32 to 1 ratio to gold at $5,000 today, and the math gives you $156 silver. Widmer's conservative version of this scenario produces $135. That is the base case. A natural bull market continuation. No squeeze, no panic, no delivery crisis. Just the ratio reverting to where it was the last time silver had a major run. That alone represents a 60% gain from today's price. Target 2, the $309 scenario. This is a different animal entirely. Widmer applies the 1980 ratio extreme of 14 to 1. In 1980, during the Hunt Brothers silver squeeze, the gold to silver ratio compressed to 14 ounces of silver per ounce of gold. Apply that 14 to 1 ratio to gold at $5,000 and you get $357 silver. Widmer's version of this scenario, accounting for various adjustments, produces $309, $309, 279% above today's price. Now here's what most people miss when they see these numbers. The $309 target is not a prediction that silver will trade at $309 on some specific date. It is a scenario that maps what happens if the physical delivery system faces a genuine squeeze at the same time gold continues its climb. It is a scenario that has historical precedent. 1980 happened. The ratio hit 14 to 1. It is not impossible. It has happened before. Section 3. The supply picture that makes the math credible. Here is where the ratio math stops being theoretical and starts being grounded in something real. For Bank of America's forecast to play out, silver needs a structural reason to outperform gold. That structural reason already exists, and it has been building for 6 consecutive years. The Silver Institute just confirmed that 2025 was the 5th straight year that global silver demand exceeded global silver supply. The annual deficit in 2025 came in at approximately 95 million ounces. The cumulative shortfall since 2021 has now crossed 820 million ounces. That is the equivalent of an entire year of global mining output. Gone, consumed, not coming back. And 2026 is projected to be the 6th consecutive deficit year. The Silver Institute forecasts a 67 million ounce shortfall this year alone. 6 straight years. the longest structural deficit run in the modern history of the silver market. Now add the mine supply picture. This is the part most mainstream coverage completely ignores. Fresnillo, the world's largest primary silver producer, just cut its 2026 silver output guidance. They revised their production target down to 42 to 46.5 million ounces for this year. Their previous forecast was 45 to 51 million ounces. That is a reduction of up to 8.5 million ounces from a single company. The largest primary silver miner on the planet is producing less silver in 2026, not more. And here is the structural constraint that makes mine supply almost impossible to fix quickly. 75 to 80% of all silver produced globally does not come from primary silver mines at all. It comes as a byproduct of mining base metals, zinc, lead, copper. When the global economy slows and demand for those base metals falls, those mines scale back output. When they scale back, the byproduct silver disappears with them. You cannot flip a switch and open 10 new high-grade silver mines. Permitting timelines run 5 to 15 years. Environmental regulations add years. Capital investment cycles take years to build out. The supply side of this market cannot respond quickly to a price signal. It simply cannot. So what you have is a market consuming more than it produces every single year for 6 consecutive years, the world's largest primary miner cutting output, and a pipeline of new supply that cannot come online fast enough to matter this year or next year. That is the floor under the Bank of America forecast, not ratio math alone, supply math that does not close. Section 4, the demand side, why silver gets hit from both directions simultaneously. Silver's demand profile is what makes it genuinely unusual among commodities. It is the only major metal that carries a full dual demand structure. On one side, monetary demand. When confidence in fiat currency deteriorates, when inflation stays structurally elevated, when geopolitical risk rises, investors move capital into silver as a store of value. That monetary demand is rising right now. Western physical investment demand is forecast to rise 20% in 2026 to a 3-year high of 227 million ounces as retail investors who missed the 2025 rally start entering the market. On the other side, industrial demand. And this is where the numbers get genuinely structural. Silver is the most electrically conductive metal on the periodic table. There is no substitute that performs equivalently in the applications that matter most. Every solar panel deployed in the green energy transition consumes meaningful silver. Every electric vehicle uses significantly more silver than a traditional combustion engine vehicle. AI data centers packed with power-hungry chips and cooling systems depend on silver-heavy microelectronics, defense systems, satellites, medical devices, 5G infrastructure. The industrial demand side of this market is not discretionary. Industrial buyers who need silver to build products cannot substitute their way out of needing it. Not immediately, not at scale. Now here is the critical point that Bank of America's forecast is built around. When monetary demand rises and industrial demand rises simultaneously, the ratio between gold and silver compresses, because silver is being pulled by 2 forces at once, while gold is being pulled primarily by one. That dual pull is what drives the ratio compression that produces $135. And if a physical delivery squeeze layers on top of that dual pull, that is what produces the conditions that in 1980 produced a 14-to-1 ratio and what Widmer is mapping as the $309 scenario. Section 5, the bear case, because honest analysis requires it. I always give you both sides. So here is the strongest version of the argument against the Bank of America forecast playing out. The $309 scenario requires a Hunt Brothers level event, a delivery squeeze of historic magnitude. That requires large concentrated players demanding physical delivery at COMEX at a scale that overwhelms the registered vault. That requires the ratio to compress from 59-to-1 all the way to 14-to-1. That is a move of historic proportions that has happened exactly once in modern history. The $135 base case requires gold to continue climbing towards $6,000 and the ratio to compress from 59-to-1 to 32-to-1. Even that base case scenario requires sustained gold strength, sustained monetary demand, and no meaningful new mine supply response. The bear case against both scenarios is real. Recession would cut industrial demand sharply. Solar substitution away from silver is already happening at the margins. Bloomberg NEF projects solar silver demand falling 7% year over year as manufacturers accelerate efforts to reduce silver intensity in photovoltaic modules. Dollar strength and a hawkish Federal Reserve under the new chair create headwinds for all precious metals, and short sellers and bullion banks can suppress spot prices for extended periods, as they have demonstrated many times in this cycle. Widmer himself frames these as scenarios, not certainties. The range between $135 and $309 reflects how much depends on whether silver's next leg is driven by fundamentals alone or by a physical squeeze that turns a bull market into something historic. That is the honest framing. Hold both sides. Section 6. What $309 actually requires, the physical squeeze scenario. Let me be precise about what the $309 scenario actually needs to happen, because a lot of coverage gets this wrong. It does not just need silver to go up, it needs a specific sequence of events. First, gold needs to continue climbing. Bank of America has flagged a path to $6,000 gold under their more aggressive scenarios. The higher gold climbs, the more mechanical pressure builds on the silver ratio. Every $500 gold moves higher compresses the ratio further if silver does not keep pace. Second, the COMEX delivery system needs to face genuine physical stress. When COMEX lease rates spike and paper claims exceed available physical silver, delivery squeezes become possible. That dynamic flashed warning signs in late 2025 when lease rates hit record highs. And as of this morning, March 5th, 2026, COMEX registered silver sits at approximately 86 million ounces, while March delivery demand has already claimed 52 million ounces on first notice day alone. Third, the physical arbitrage channels need to stay closed. China's export licensing system implemented January 1, 2026 blocks clean physical arbitrage between Shanghai and Western markets. As long as that system remains in place, the physical pressure on Western delivery cannot be relieved by Asian supply. If those three conditions align simultaneously, the ratio math that produces $309 is not theoretical. It is the same math that produced $309 in 1980 nominal terms. Adjusted for where gold trades today, the same ratio extreme produces the same number Widmer is pointing at, Section 7. What other institutions are saying, Bank of America is not alone. One more piece of context before we get to what you should actually watch. Bank of America is not the only major institution making a case for dramatically higher silver. Citi has a 2026 silver price target of $150. JP Morgan projects silver could average $81 per ounce for the full year, which implies a significant second-half recovery from current levels. Gold Silver's Alan Hibbard told investors he would not be surprised to see silver increase by over $100 per ounce in 2026 to $175 or higher. And the Silver Institute, the industry body that tracks global supply and demand with the most comprehensive data set available, stated directly that the dynamics driving silver to record highs above $120 remain firmly in place. Their words, not a YouTube channel, not a Reddit post, the Silver Institute. When multiple major institutions, a major investment bank, and the industry's own data body are all pointing in the same direction, your job is not to dismiss it. Your job is to understand what would have to happen for them to be right and what would have to happen for them to be wrong, because one of those outcomes is coming. Section 8. What to watch to know which scenario is playing out. All of this data is public and free. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. You find me here on YouTube and on X. Here is your watch list. Every item is free and public. The gold to silver ratio. Track it daily. You can find it on any metals data site. Right now it sits at approximately 59 to 1. Watch for compression below 50 to 1 as the first signal that silver is beginning to outperform gold on a sustained basis. A move below 40 to 1 would put silver at $125 with gold at $5,000. A move to 32 to 1 puts you at Widmer's $135 base case. The ratio is the single most important number in this entire forecast framework. COMEX registered silver inventory, updated daily on the CME website, currently at approximately 86 million ounces. If this number drops below 70 million ounces while March delivery is still in progress, the physical stress scenario that underpins the 309 target moves from theoretical to active. Fresnillo production updates. The world's largest primary silver miner already cut guidance. Watch for further production revisions in their quarterly reports. Additional cuts tighten the supply picture further. Gold price trajectory. Bank of America's $6,000 gold scenario is what mechanically produces the highest ratio targets. Watch whether gold sustains above $5,000 and builds toward $5,500. Every step higher on gold increases the mechanical pressure on the silver ratio. Silver spot price around key levels. Watch $91 as near-term resistance. A break above $91 on sustained volume confirms bullish continuation and opens the path toward $100. The $78 level is the structural floor on the downside. A hold above $78 through any macro volatility keeps both the $135 and $309 scenarios mathematically alive. Western physical investment demand. The Silver Institute projects a 20% rise in bar and coin demand in 2026. If that number comes in above forecast, it adds monetary demand pressure on top of the existing industrial deficit. Watch monthly retail dealer inventory reports as a leading indicator. Section 9. The honest conclusion. Here is the full picture as of this morning, March 5th, 2026. Silver trading at approximately $84. Bank of America's Michael Whitmer, head of metals research, has issued a $135 to $309 price target for silver by end of 2026. The $135 base case. Gold at $5,000 with ratio compression to 32 to 1. A 2011 level ratio reversion. 60% upside from today. Requires no delivery squeeze. Requires only a natural continuation of the existing bull market. The $309 extreme case. Gold at $5,000 with ratio compression to 14 to 1. A 1980 Hunt Brothers level ratio extreme. 279% upside from today. Requires a physical delivery squeeze that overwhelms paper markets. Silver in structural deficit for the 6th consecutive year in 2026. The Silver Institute projects a 67 million ounce shortfall this year. Cumulative deficit since 2021 now exceeds 820 million ounces. Fresnillo, the world's largest primary silver miner, just cut its 2026 production guidance by up to 8.5 million ounces. 75 to 80% of global silver supply is a byproduct of base metal mining, cannot be scaled up quickly regardless of price signal. Western physical investment demand forecast to rise 20% in 2026 to 227 million ounces. The retail buyers who missed 2025 are starting to move. COMEX registered inventory at 86 million ounces. March delivery demand already claimed 52 million ounces on day one. The physical stress scenario that underlies the $300 target is not theoretical. It is live right now. Citi at $150. JP Morgan projecting strong second half recovery. Gold silver at $175 plus. The Silver Institute confirming the structural drivers remain firmly in place. The math behind Bank of America's forecast is not hype. It is ratio mechanics applied to a real supply deficit in a real market with real physical stress building right now in the COMEX delivery system. Whether silver gets to $135 or $309 or somewhere in between depends on which of the scenarios I described today actually plays out. The ratio is the number to watch. The COMEX vault is the number to watch. The gold trajectory is the number to watch. The data will tell the story. Your job is to actually look at it. Most people will not. Because looking requires sitting with the possibility that a number like $309 is not a fantasy printed by someone trying to sell you a newsletter. It is a scenario mapped by the head of metals research at one of the largest banks on the planet, using the same ratio math that described the 1980 extreme. The minority who look do not need convincing. They simply position accordingly. Invest with logic, not hype. Protect your capital. Respect the math as much as you respect the chart. Drop OG in the comments if you are tracking the gold to silver ratio today.